Hello students, I am Rahul Sharad Joshi, Assistant Professor at the Department of Commerce, the Bhopal School of Social Sciences. Today we are going to talk about the capital market. Now let's start with it. First of all, let's start with the concept of capital market. Now you can see capital market is a part of financial market where long term and medium term instruments and securities are created. In this market, with the help of various institutions and systems, long term financial resources are transferred from savers to the needy persons or to government or other institution. A business firm can collect the funds or raise the funds from various sources. Short term funds can be collected through money market, and you can see long term, medium term funds can be raised through capital market. Now coming to functions of capital market, you can see the first of the functions of capital market is resource or saving mobilization. Then we have it promotes industrial growth, it provides liquidity to investors, investors can sell and buy the shares at their convenience. It is always a source of long term funds, company can raise the funds with the help of capital market. Then there is the provision of various financial services, and it also inculcates the inflow of foreign investments. Then we talk about the money market and capital market and difference between both of them. You can see the purpose of money market is liquidity adjustment, whereas the purpose of capital market is link between the long term investors and borrowers. Risk in money market is literally zero, and when we talk about capital market, there is a market and capital risk going on. Guarantee, money market instruments are guaranteed by the Government of India, and there is no such guarantee in case of capital market. Period is money market instruments are within 1 year, and they are more than 1 year normally in case of capital market. Money market is regulated by RBI, whereas capital market is regulated by SEBI. And when you talk about uncertainty, money market is certain, whereas capital market is bit uncertain. Now let's talk about components or parts of capital market. We are talking about the government security market first. Now how do we define government security market? Any security issued by central government, state government or any local authority is known as a government security. As government cannot default on its payment, so they are risk free securities. When we talk about government securities, they are basically risk free securities. Under this category we include central government, state government, local authority and electricity housing board securities. Now what are the features of government security? They are risk free, there are guaranteed returns, they are guaranteed by the Government of India, then they are issued by RBI, they are most liquid securities. Normally high value transactions are done in case of government securities, and they are issued by auction process. Now coming to corporate security includes those securities which are issued by non-government public companies, and the securities issued are like equity shares, preference shares, debenture, bonds, etc. Now what is the difference between a government security and a corporate security? Talking about risk, in government security, as they are guaranteed by the Government of India, there is no risk element, whereas in case of corporate security the risk element is very high. When you talk about return, there are fixed return in case of government security, and the returns are uncertain in case of corporate security. Transaction value is high in case of government security, and the transaction value is medium or small in case of a corporate security. Issue method is through auction in case of a government security, and when we talk about corporate security, it is through a public offer. Then participant, in case of government security, the participant is bank or a financial institution, and in case of a corporate security, there are many participants including individuals. Default not possible because government is responsible, and in case of corporate security, yes, default risk is always there. Public participation very low in case of a government security, and public participation is very high in case of a corporate security. Regulator of a government security is RBI, and when we talk about corporate security, the regulator is SEBI. Now coming to the components, now let's talk about primary market. Now when we talk about primary market is also known as a market or a source of new securities. When an investor invests in securities by purchasing it directly from the company, it is called as primary market. Primary market is also known as an IPO market or initial public offer. Whenever a company comes for the first time in the market to raise the money, it is known as an IPO, that is initial public offer, and whenever company raises money or the second time or the third time, it is known as an FPO, that is follow of public offer. Now securities which can be issued in primary market consist of notes, bills, government bonds, corporate bonds as well as stock of companies. Now when we talk about the functions of primary market, the first one is transfer of resources. The main function of primary market is to facilitate the transfer of resources of funds from saver to users. That is the basic function of a primary market. Then we have distribution. Primary market allows all the systems and services for the distribution of the securities from the issuing company to the investors. Then another function is the underwriting of securities. Now what happens in underwriting? For a public offer to be successful, some percentage of securities have to be subscribed by the individual investors. If that particular subscription is not raised, then we say that IPO has failed. So, in this particular case the underwriter comes into picture and he is one who is responsible for subscribing to that unsubscribed issue so that the IPO becomes a success. So, let us see what we have written in underwriting of issue. Underwriting is a kind of guarantee undertaken by an institution or a firm of brokers ensuring the marketability of the issue. Now, it is a method whereby a guarantor makes a promise to the issuing company that it would purchase a specific number of securities if not subscribed by the general public, so that the IPO becomes a success. Then what are the methods of issue in primary market? To start with, the first one is through prospectus. We issue a prospectus to the general public. On the basis of that prospectus, the general public makes up the mind whether they should invest in the capital market or not. Then we have offer for sale. When one or more existing shareholders of the company sell their shares to the public, this is known as an offer for sale, and normally Government of India uses this method for disinvestment purpose. For example, sale of shares by the Government of India of public sector units like SBI, LIC or BHEL. Then third one, we have placement of shares. Now, when a company issues its bulk of the shares to a single investor or a group of investors, it is known as placement of shares. Then again we have a rights issue and bonus issue. In case of a rights issue, a company issues rights issue to its existing shareholders on the basis of certain proportion. You need to be an existing shareholder in order to be eligible for subscribing for a rights issue. Rights issue are always issued in particular proportion. Then, but the only thing is you need to pay some amount to the company for having that rights issue, and normally the amount paid is less than the market price. If you do not want the rights issue, then what you can do is you can transfer the rights in favor of some other person, and then he has to pay the money to company to get those shares. That is about the rights issue. Then we talk about bonus issue. What is common between bonus issue and rights issue is that they both are issued in some particular proportion. The only difference is in case of rights issue, you need to pay some money to the company for buying right share. Normally that price which we pay for the right share is less than the market price. Now, when we come to bonus shares, there is no money involved, there is no flow of money from investor to the company. Now, in bonus share what the company does is it capitalizes its reserves. So, it increases its capital by transferring the amount from reserves to the capital. It does not take any money from the shareholders. So, this is what is bonus issue. In the next PPT, we will be talking about secondary market. Thank you.